have a number of video clips to show you that I think will be very interesting. I'm going to begin with one. I'm featuring one from Simon Hunt, and I'll cover that in just a minute, and some others that will deal with inflation, the Fed, debt, collapse, things like that. So I'm Ben Ripond. Welcome to my YouTube broadcast. Today is March 7, 2023. I'll begin with Simon Hunt. He is a British economist, has been and is a macro market analyst and economics analyst. He has been in business for over 40 years. We don't hear about him a lot in the U.S., but in the financial circles around the world, and especially in the U.K., he is fairly well known. He is doing this interview. He's doing an interview, and it's from his office in Dubai, and it's very interesting. I think you'll see that he is predicting what Mike Wilson from Morgan Stanley predicted, and others who have said there is expected to be I won't say a collapse, but a very sharp pullback, not just a pullback, but a deeper decline in 2023. And he is predicting that for mid-2023. So it's interesting how this correlates to others that I have played. Then he sees a sharp increase in equity and bond prices for the next couple of years, going into 2025. So kind of some not so good news for the coming months. And then for a year or a couple of years after that, some very good news for equity and bondholders. But then he predicts, and he goes into why, a global depression with a D. And he explains why that is. He predicts that bond yields will exceed 10%, and that bond prices will collapse, and equity prices will collapse at that time. So it's a mixture of some not so good news mixed with some good news. So I think you'll find it interesting. He's in my opinion, very credible. And I got his name from one of our viewers, and did research on him and found that this was substantive and credible. So take a listen.
What's your current assessment of the global economy and financial markets?
I think we have a false dawn. I think that as we look out to 2025, 2026, we will basically see three phases of ups and downs. Between now and the middle of the year, we will have a very large correction in global equity, bond, and commodity markets. This will force the Fed and other central banks to ease monetary policy, produce a form of QE, and rates will start falling. That will result in a resurgence of inflation, particularly energy and food prices. The dollar will start falling sharply. With inflation rising, equity and commodity markets will surge to new highs by the end of 2025. But at the same time, the long end of the interest rate curve, which central banks cannot control, will be rising. The yields will be rising very sharply. For instance, we have 10-year treasuries yielding well over 10%. That will result in the highly leveraged parts of the global economy basically going bust.
Next, Melissa Lee at CNBC interviews Rebecca Patterson, former chief investment strategist at Bridgewater Associates. Now, many people know what Bridgewater Associates is, but that is the fund that is managed by Ray Dalio. And she was a chief investment strategist. So a very high level position and a very credible person. She points out that the consumer is being very stretched due to inflation, and that they are facing higher interest payments due to higher interest rates, and that this will lead to a slowdown in hiring and layoffs, and even to defaults. She predicts, again, so think of Mike Wilson, Morgan Stanley, Simon Hunt, Jeremy Grantham, and others who have said this, and a sharp decline in equity prices, and she says later this year. Some are saying second or third quarter, some are saying later this year, but everyone is saying we are in for a decline, and then when that happens, the market will have the excess, in my opinion, have the excess flushed out of the system and be ready to resume an upward trend, but not until that occurs. So take a listen to Rebecca Patterson, former Bridgewater chief investment strategist.
Our next guest warns consumer spending activity suggests big trouble ahead. Rebecca Patterson is a former chief investment strategist at hedge fund Bridgewater Associates. She's out with a CNBC op-ed today. The calm before the storm. These three drivers will dictate the landing ahead for the U.S. economy. Rebecca, welcome. Great to see you. Great to have you on Fast again. Before we get to the three drivers, Wile E. Coyote moment. That doesn't sound like a good kind of moment for the U.S. consumer, and that's exactly what you think is going to happen.
I think that's where we're headed. It's interesting. Target was a perfect example of the dynamic. You know, their earnings for right now, fine. Their expectations soft, and the consumer right now, fine. But where are we going? And so when you think about what's holding up the consumer right now, they spent down all their excess savings from the pandemic fiscal transfers. And what struck me and what really prompted me to write this piece was the Federal Reserve report that came out recently that showed that in the fourth quarter, we saw between mortgages and credit cards, $400 billion going on to total household debt balances. That was the biggest increase on a quarter that we've seen in 20 years. And credit card interest rates today are up to 20%, which is also a multi-decade high. And I look at this and say, okay, the consumer keeps piling on credit as long as the job market's tight and they have incomes. But what if companies start to pull back? Or what if consumers just say, maybe I need to be a bit more cautious? And on the latter, we saw that today in the Conference Board February Consumer Confidence Report. It showed current conditions strong, consumer expectations the weakest we've seen since last July. And so we're not there yet. That's what makes this tough. But you're starting to see more and more dots, more and more markers that are telling us that the consumer is going to get more cautious. And when they do, think about the linkages. If the consumer's spending less, it's less revenue for a company. Companies are making less money. Guess what they're going to start doing? Paring back CapEx, paring back hiring. Greater layoffs means there we go, and we get the earnings hit. So I do think we're looking at equity market downside later this year. And I would be watching that interplay between the consumer, companies in the labor market, and of course the Fed and those borrowing costs.
So Melissa Lee also does an interview with David Rosenberg, and he predicts that with the rising interest rates, that there will be this will have an impact on the market, the equity market, and a softening of the job market. Jobs have been very strong, and he sees that this will start to soften the job market, meaning more layoffs and harder for some to get jobs. And follow this now. So Rebecca Patterson, Simon Hunt, and former videos I've done with, as I said, Mike Wilson, Felix Zuloff, and others, falling equity prices in the second and third quarter of 2023. Again, the theme just keeps saying the same thing. But if equity prices fall far enough, then the market is ready to resume an upward trajectory. So I think it's good to see this from both lenses, both the protecting the downside risk for investors, because there is immediate down, or at least in the short term, downside risk, and then be prepared for the market to turn, probably when you don't expect it. And hopefully we'll see this start to occur in the latter part of this year. So take a listen to Melissa Lee and David Rosenberg.
For more on the impact of surging rates, let's bring in David Rosenberg, founder and president of Rosenberg Research. David, great to have you with us. And I wanted to ask you about, a part of the conversation we were just having, and that is what the HYG and the JNK is telling us. And I'm wondering if you see glass half full or glass half empty here, because the chart really says that maybe there's not too much going too badly. And I'm wondering, when you think about this lagged effect of rate hikes, when does that start hitting this part of the credit market? Because you would think that it would start hitting now.
Well, I think that when you're taking a look at the leading indicators, and we just got the money supply numbers today, and M2 is down a record 1.7% year over year. That's a leading indicator. I heard you guys talking about the yield curve. Another ironclad leading indicator, there's the Fed Loan Officer Survey, which has tightened dramatically in the last quarter across all types of bank credit. These are all leading indicators. It's a matter of timing. I think that right now you've got a situation where the stock markets and the credit markets seem to think that they have more time that they can buy before the boom really gets lowered on the economy. There's no doubt the economy is not strong, but it hasn't weakened precipitously. But the one thing we have to keep in mind is, whether it's money supply, the LEI, the yield curve, all these other things that we have in the crystal ball, it's telling me that the recession probably starts Q2 no later than Q3. And the time horizon for the markets, whether it's credit or equities, is shortened up so much that it's only when they see the whites of the eyes. And I think a lot of it will have to do as well with employment. Employment has to start contracting. Once employment starts contracting, and of course that's the bellwether coincident indicator, I think that's where you're going to find the risk on trade, really coming under downward pressure. Reality is that we're not there yet, but give it, I'd say, 3 or 4 months, and we're going to have a different economic picture on our hands.
I love playing Jonathan Farrow and Mohamed El-Erian. There's a lot of material. It just keeps coming. It seems like every week. And I love the thinking of Mohamed El-Erian because he is so insightful. And so he is talking about the idea that this is a hard market to read. And boy, it is a hard market to read. 2022 was full of head fakes, where the market generally went down, but there were several times, 4 or 5 times, where the market tried to go back up, but couldn't, and then it fell. As we look in retrospect, we can look at that and say, oh yeah, it was a downward trajectory. But when you don't know the future, and you're used to these buy the dip ideas, where it goes down and then it goes on back up, that didn't happen. And so it was a very hard market for investors and money managers to read. And he says, here we are again. This is the January and February and early March have all looked a lot like 2022. Very hard market. It goes up and then it collapses. It goes up and then it collapses. So he said, very hard to read. And that the Fed is behind the 8 ball. They always seem to be slow to respond, and in a number of ways, interest rates and then the selling of assets. So hard decisions are ahead. So listen to Jonathan Farrow and Mohamed El-Erian from Bloomberg.
Mohamed, how about that PCA print from about 30 minutes ago?
Yeah, this is bad news. It's bad news. And it's bad news across the board. It's bad for the economy. It's bad for livelihoods. It's bad for bonds. It's bad for stocks. It is just bad news.
Put it all together for January. Where does it leave this Fed?
Behind yet again, and for the 3rd time in this cycle. I think right now they're going to have a very serious discussion as to not only should they have done 50 last time, which they should they do 50 next? And it's a really tough discussion.
You said going into the last meeting, they needed to go 50. You thought they'd go 25. Chairman Powell in that meeting talked about the disinflationary process beginning. Then we all read the minutes. You counted how many times he said disinflation in the news conference, 11, right?
Right.
Then in the minutes, 0.
Right.
What's going on there?
So, I refer back to what you said yesterday, is the question, can they massage, that's the word you use, massage the minutes to reflect subsequent data? I don't know, maybe Mike McKee can tell us, but the minutes were not consistent with the message of the press release. But I think even this word disinflation can't be said anymore. Inflation is heading the wrong way.
So January data, bad on the inflation front, good on the output front. To see claims where they are, unemployment at 3.4%, wage growth still in and around where it is. We've got payrolls where 517,000, just phenomenal numbers here, Mohammed. Do you think that continues? Do you see signs, evidence that that's durable through the next couple of months?
So we see evidence that the economy is slowing, and that's a real issue because you don't want the Fed to be forced to hike a lot into a slowing economy. So we are seeing evidence that the economy is slowing, but the labor market remains really strong. So it is a very difficult economy to read. I just want to stress, this is a very difficult economy to read. I could sit right here and give you 3 scenarios for growth, 3 scenarios for inflation, and 3 scenarios for monetary policy. Now think of how many interactions you get in this 3+3. This is a really tough environment both to predict and to invest.
So we've been talking about interest rates and Fed rate hikes. And the effect of rate hikes on bonds, we know there's an effect on equities. It causes generally a decline in equities. The bond or bond funds or bond ETFs are also under pressure. So this is a picture of the 20-year government exchange traded fund, TLT. And you can see over the last 15 months or so, you can see the decline. The decline is over 30% for the long-term government bond or the bond fund. And this has a very negative effect on traditional portfolios, buy and hold, 60-40, target date funds in 401k plans, et cetera. So many people are down at least 15%. And at the worst point, most were down 20 to 30% based on what I saw with people who called me. So it's just a intermediate term picture of what is going on with the government bonds. When you get to the intermediate term bonds or the short term bonds, they all look similar. It's just that they happen in different degrees. But this is the effect of what they're talking about with rate hikes. The Fed is doing 2 things. One is they are raising rates, and we've spent time talking about that. The other thing that they're doing and have been doing since last, I think it was last May, they started selling $47 billion a month of assets off their balance sheet. And then in September, they started selling $95 billion a month off of their balance sheet of both treasuries and mortgage-backed securities. So this is a picture. This shows how bloated the balance sheet is for the Fed. And they need to get rid of this. This was done as a stimulus, and they need to get rid of it off of their balance sheet. So what has happened this last week, they sold $43 billion off of their balance sheet. And this is a picture that shows that they have sold $500 billion of treasuries off of their balance sheet. When you get to the mortgage-backed securities, that is over $200 billion there. So over $700 billion of treasuries or mortgage-backed securities are being sold off their balance sheet. So you say, okay, so what, Ben? What does that mean? What it means is two things. One, they have flooded the market, so that's going to force prices down, which I just showed you. And secondly, they're sucking liquidity out of the market. So when you suck that much liquidity out, money supply out of the market, you're going to put a drag on the economy and probably on equities as well. I saw this article last week on Bloomberg, and it caught my eye, and I thought about this. And the article was really interesting. Car debt is piling up as more Americans owe thousands more on their vehicles than their vehicles are worth. And the article went on to talk about people who are taking their cars into car dealerships to buy a new car, and they have negative equity, meaning the car is worth less than what they owe. They started the article by talking about a couple in Atlanta who had two cars, and they needed a different kind of car because of their family. So they took and both cars were underwater, meaning they owed more than the car was worth. They combined the two and then presented them to the dealership, and they were negative $17,000 compared to what they were worth. Now, a car purchase is a big deal. There are two big purchases we make in our lives, usually. One is our home, and the second is our car or a series of cars. So it's a big purchase. So this couple bought a new car, the way the story goes, and it was selling for $49,000. They were negative $17,000. So what the dealership did is they rolled that $17,000 into a new loan and loaned the people, or the bank loaned the people, $66,000 on a $49,000 car, which is going to go down in value as soon as they buy it. Now, you scratch your head and think, that does not make sense. So I reflected on my own life over the years and how I've done this, and I haven't done it perfectly, but I've done a lot of different things, and maybe you have. So I remember buying very, very nice cars. I even bought one that was an amazing car. And I bought, average cars. I bought new ones. I bought used ones. I financed them and had payments that I owed to the bank. I've paid cash. I've done every combination you can think of. I even leased one time, a long time ago. And I thought, I don't have any judgment about this, but I think it's the effect that there's two things. I thought, well, why don't I do that today? Because I think two things. One is Montana. So in Montana, people don't tend to do that. You tend to buy what you can afford, and there are people who buy cars with car payments, and there's a lot of people who don't do that, and they pay cash, and they buy a used car or truck, and it's not the fanciest in the world, and they're okay with that. It's not about being showy, and it's just kind of a Montana culture. And part of it, I think, is my age. As I've grown and gotten older, I think, okay, I don't look at things like I used to. So that does not have the attraction that it used to have. But so I drive a 25-year-old Dodge diesel pickup. I'm totally happy with it. I use it around the property for work, and then I also drive it back and forth to town. I don't need a new truck to do that. So I'm happy with that. Maybe one day I'll buy one, but I don't have any desire to impress someone or to buy a new truck. So, and of course, it's paid for. So this concept of buying something new and having debt and rolling it into another one, being negative equity, the article said there were 15% of the people who have car payments, and many people have car payments, 15% of them have payments that are $1,000 a month or more. 15% of the people buying cars have $1,000. That does not make sense to me. I can't even imagine that. Now, I have my beef with Dave Ramsey and his investment advice. I think it's horrible investment advice. But the one thing that Dave Ramsey does get it right on is on debt. And I've listened to him, and he says, hey, and people call in, and if you're underwater, hey, figure a way to get rid of that car, take that debt, pay it off, and go buy yourself a beater. Okay? That's his advice. I think that's good advice. You don't need to go to a dealership and take your car in that you owe more on than it's worth and go buy another one. Or even if you can't afford it, buying a new one. It just doesn't make sense. I read something where he said, you shouldn't buy a new car unless you have $1 million in the bank. I thought that was good advice. Go buy a new car when you got $1 million in the bank. Otherwise, go buy what you can afford. So, in the article, it reported that a lot of people are taking cars in that have that they owe $10,000 on or more to buy a new one. It reminded me of this story of Sam Walton. Sam Walton drove his 1979 Ford pickup, and he did it so he could put his dog in the pickup because he didn't care about, keeping it nice and so forth. And probably at the time, maybe at the time this was taken, he could probably have afforded to buy every Ford dealership in America. And he chose to drive a 1979 Ford F-150. And so I'm not certainly going to imply what you should do, but it just was a wake-up call to me. So when Rebecca Patterson earlier in the earlier video, when she referred to the credit card debt and the mortgage debt that people have, which is increasing at a significant rate. And then I read this article about these car payments. So that adds on top of the debt that people are incurring with credit cards and mortgages. And so not only are we as a country at 31 trillion and climbing very fast on our debt, but the consumer, the average person, not everyone, but a lot of people are taking on debt in both credit cards and in car loans. It's called consumer debt. And it's not necessary. Each person has got to figure out what their values are and how important that is to them. But I don't believe that any of you would have car payments of $1,000 a month or more, or that you would have negative equity in your car. I certainly hope that's not the case. Okay, finally, the flow of funds report. This is the showing where money is going. Money continues to go out of equity funds and into the safe haven of bond funds, 2 million out, 8.7 million in, and then into 2 billion out of equity funds and 8.7 million, which is barely a blip, going into bonds, and 4.9 billion going into money market. I'm going to conclude with this. I thought it was interesting. It's just about a very brief piece on the population, what's going on in China. Population, for the first time in over 60 years, the population has begun to decline in China. It has been going up, which has fueled their economy, and now their economy is struggling, and for the first time in 60 years, there's a decline in population. Anyway, take a listen to this. I think you'll find it interesting, and then I'll wrap it up after this.
China has always been known for its massive population size. It's home to 1.41 billion people. That means nearly 1 out of every 5 human beings on Earth lives in China. But now that number's shrinking for the first time since 1961.
China's population has declined for the first time in more than 60 years. According to numbers released Tuesday by China's National Bureau of Statistics, the population in 2022 was just over 1.4 billion, a drop of 850,000 from a year prior.
So the recent news that Chinese population has declined for the first time in decades, in many ways is a big deal because it marks the end of this era of rapid growth and of cheap labor.
If the labor costs in China are no longer cheaper than other countries, China will lose its comparative advantage in manufacturing goods for the rest of the world.
Consequently, your prices of your iPhones, the prices of your cars, and many of these things are going to rise. And so the global consumer is going to feel what's happening. So what's happening in the bedrooms in China is actually affecting what's happening in the rest of the world.
Okay, thanks for watching. If you have comments or questions, leave them in the comment section and I will try to answer them. Thank you again.